All right, late Sunday morning here, and let's start out another weekly recap with a big emphasis on the word recap. And you're going to realize that in a few once I get through the content. Now, it was a pretty eventful week, as you will see, or, well, of course, if you follow the markets, you already seen it. But anyway, The the big focus of the week for me personally was all on equities, so indices, U.S. stock market, and whatnot. But that doesn't mean we are not gonna look at what the usual suspects did throughout this week, of course. But a little bit of a disclaimer, I'll try to go really quickly through the usual gold, oil, Bitcoin, and whatnot, because there is kind of a message that I wanted to deliver when it comes down to making assumptions, making hypotheses, coming out with biases and whatnot, and then seeing them developing and maybe unfolding or maybe not. Because a few messages, I got a few conversations throughout this week that I think is a little bit of a relevant point to discuss. Okay, so let's start out, of course, with the economic calendar. As you can see, the week was full to the brim with data points, not only from the US, of course, but I guess the main ones, of course, were from the US. So we got PPI, we got, of course, the big one, CPI in the US on Wednesday, and then we had the retail sales, the unemployment claims or jobless claims, whatever you want to call them. So you would expect a pretty uh, volatile week when you look at the economic calendar on maybe a Sunday night or a Monday morning, you know. But we're going to get to it in a minute. Now, just looking at the data before going ahead with the charts, we've seen, for instance, that if you look at the PPI, there wasn't really um, a major surprise. A little bit on the deflationary side, probably because the previous was at zero point 0.2, came in at zero point 0.1. The core previous were zero point 0.3, came in at zero, so a little bit lower than previous and lower than expectations, but it's not 0.1%, 10 basis point. Not a huge deal, right? And sometimes, what's really matter in these type of data, it's not the actual data itself, but more of the trend. Okay, same for CPI, right? It was forecasted at 3, same as last month, came in at 2.9, so not a lot, right? But still, the trend it's still on the disinflationary side of things. Now, uh, let's go into the charts. And of course, we are going to start out with currencies again. Just for the sake of it, we're going to have a look at the DXY, which kept on going down. We broke through the EQ of the micro range. We retested it. And right on Monday, right? Yeah. And then we came back down. The yen, which is this time, is already inverted. So you can see it's basically moving the same way that the euro and the pound are moving relative to the dollar. So we don't have to go through that inverse type of relationship, which is given by the fact that the USD is at the numerator in here, right? Now, a little bit of a pullback in the yen, and on Friday, closing up the week with a little bit of a rebound, but nothing major, to be fair. So, of course, you've seen the euro, which kept on going higher. Um, and my, my doubt about the pound, which I said is relatively closely correlated pair to the euro. So I was expecting a little bit of a catch up from the pound compared to the euro, and we had a good, more than a decent week for the British pound this week. It went up substantially, I'd say. Started out the week at around 1.27, mid 1.27, and it closed down at 1.29, mid 1.29. So good pump from the pound. And of course, since these are coming up, the dollar is going down relatively to the others. So again, these fears of the carry trade unwinding uh, have been a little bit toned down. As I said last week, sorry, uh, these deleverage events they tend to be short-lived up until the point you wash out all the over-leveraged actors. Might be hedge funds, might be banks, might be other participants in the market, but if it's just about an issue of over leverage, with these sort of moves, you know you're going to wash out a lot of them. And it looks like, at least standing to the markets currently, the portion that was needed to be washed out has been washed out, and things are coming back, let's say, into balance, maybe. Or at least there is not that urgency of being so worried, being so wrapped up into these unwinding as it was, let's say, 1 week ago. All right, it looks like the emergency has got back into a little bit more of a relaxed type of issue. Now we know it's still there, but it's not as prominent as it was on that infamous Monday where the S&P gapped down on Monday by almost 4%, right? So for now, situation is coming back in a little bit of a more of a stable type of condition. Now we don't know. It could be that from here, you got a reacceleration of the yen. Who knows? But standing to the BOJ, currently they said most likely they are not gonna hike rates again up until next year. So, I mean, who knows? You want to trust the BOJ or not? But that's what they said, and that's how the market kind of took that speech, that statement, and that's the price action. So, do what you like with it, right? Let's look at oil. Oil went down, and I was looking at it on, I don't remember if it was on Monday at the open or Tuesday. Probably was on Tuesday. Let's see. Yeah, I guess it was on Tuesday. The 13th of August was, yeah, Tuesday. So I said, you know what? I was expecting a little bit of a pullback from this area, kind of like what we had in the previous one. You fill in the gap and you take out a good amount of liquidity around above these highs, same as we did in here. So I was waiting for it, and I was expecting lower oil prices, especially, I always look at the break evens, and with oil going up so much, they didn't go up, not as nearly as the price action you've seen in oil. So I was expecting a little bit of a pullback in oil, and the futures curve was still oriented to the downside if you go down the curve. So that's the main reason I was saying, you know what, oil will probably pull back a little bit here. Don't know how much, but realistically at and around the lows, and that's what we've seen. So that was good, I guess. Um, don't know where it's gonna trade next. Um, if you look at the current trend, it looks like we might revisit the lows, but I always say don't be impatient with oil. Uh, that's the way it moves. He it gets massive spikes and then it pulls back massively. So it is a market which is highly influenced by news and by geopolitics events. So just always be careful with oil. And like in many other markets, of course, but I feel sometimes like, especially with commodities, you should always be on the high watch because I do perceive commodities as highly manipulated. And in my vision, in my opinion, same goes for gold, for instance. So always be careful with it. Speaking of gold, let's see what gold did. Wow, gold went up very organically, very orderly. It went up. So we left it last week, uh, during the last weekly recap video, and it didn't, at the time, it didn't make a new highs, right? Looks it did now. It's particularly good, actually. It went up, it drew back a little bit because it opened up on Monday with an upside move, went down, and then Thursday and Friday it closed closed the week with a very positive close. Now, I was looking at the fundamentals a little bit when it comes down to gold, and I'm reading this again. Last week, I brought up the inflation edge type of mechanism and the comparison in between gold versus stocks, and but now I'm reading gold is going up because it is just an anticipation of Fed rate cuts. So I mean, could this be? Maybe. I just wanted to have a look at it and say, you know what, Fed funds. Let's see. Give me a new panel, right? Okay. So let's see overall over the long run what happens to gold compared to Fed funds, and let's delete that for a minute, just for the sake of it, right? I already had it, but then I had to turn down TradingView and the entire computer, so it went away. But now I can see that I'm referring to the Fed funds relative to the oil price, is the gold price. So let's see. Let's start out. Let's take recent as examples, right? We do really need to get back to the 70s, I'd say, but the market has changed a little bit recently. So let's just look at the 90s, okay? So the narrative is rates go down, gold goes up because now the incentive of holding gold, which of course it doesn't yield you nothing, right? So the incentive of holding gold over, let's say, treasuries goes up if rates go down because the yield that you might have in holding treasuries or bonds or fixed income, if the yield is going down, that opportunity is dissipating. So why not instead holding gold, which is of also a safe haven because you think about rates going down, it means economic slowdown, lower growth and inflation expectations. So would you hold gold? Wasn't it an inflation edge? So if rates are going down, so slower growth and inflation expectations, you buy into gold. Well, I mean, people seem to think that way, but let's check it out. So we see cuts in the 2000s, and gold goes up slowly. All right. Then we see rate hikes right here from 2004 to 2006. But what is up with gold? It's going up. All right. Rates stay relatively flat. Gold is grinding higher, and again, rates are cut. Gold goes up. Then, of course, you got 2008, so it was a massive liquidity event. Gold was just selling off because nobody was having the liquidity they needed, so they just started to liquidate gold in order to get the liquidity, which of course is the main function of gold. There is an insurance policy, and you most likely always get a bid with gold. So if you run out of cash and you need to cover losses in other portions of your portfolio, you can liquidate gold to cover the losses. And then, of course, that's what we've seen. Then rates stay flat around 0%. Gold went massively up, of course. But at the same time, it also went down quite a bit when rates didn't move. So let me check how much from the peak. Um, it came down almost 50%. Rates didn't move. Okay. So rates go higher and gold go higher. Hmm. I mean, I'm already seeing that this correlation to Fed funds or to interest rates, it's not really holding up. The gold comes back down while rates keep on going higher. All right. Then finally we got rate cuts getting into the pandemic. Gold, of course, goes up. Rates stayed relatively stable around 0%. Gold established a trading range, and then rate hikes. Gold went initially down, but then while the low was established while rates were still going up, right? But gold just started to pump. And now it's pumping while rates are relatively stable in anticipation of cuts. That is the narrative. My interpretation of it, rates are, rates don't have a saying into it. I still think the way gold is traded and treated by the market, it's not about these type of I mean, it can be an inflation edge, of course, and we do know that gold tend to maintain its purchasing power over time. Why not? But it looks to me the major component, especially recently, which is driving the price of gold up, and I've talked about it in a video I posted, but mainly was about the strength of the US dollar, and I was kind of sarcastic, like I said, you wouldn't expect the DXY shooting higher to bring up the price of gold consequentially. Because I don't know if you remember, but I was saying, you know what, the DXY is reaping higher. Those other countries are seeing their currency being crashed against the dollar, but everything around the world is kind of priced in dollars. So you know what? I'm gonna buy that one thing which is outperforming the dollar and therefore hedging my own currency against the dollar, reaping higher. And therefore, major central banks around the world were buying into gold. Could it be? Maybe. I mean, I think it was, but I'm just saying maybe for, taking a little bit of a leeway there to just leave the door open for other possibilities, of course. And then I think now another thing you could add to it is that gold has no counterparty risk. It's no one else's liability, so you know is another characteristic of gold that I guess it's particularly interesting in times of uncertainty. Because don't get me wrong, although the markets rebounded all across the board, I don't think the uncertainty has just evaporated overall on a macro scale. So that could be it for gold, maybe. Um, on the technical side, it's trading particularly well. So last week I said this was my invalidation point. I brought it up to here. Would you bring it up to this low? For me personally, no. I mean, I'm just saying I wouldn't be surprised to see, let's say, gold trading a little bit back, even at and around these lows, and then resuming the uptrend. Okay, so to me, the invalidation point is still the same, which would be this one. I know it's not perfect, but that's what I would do. Now, you're talking about seeing it coming back down what a good 5%, 6% before making your call and leaving out the position. Probably, yeah, but it's kind of the same. If he breaks this, you shift from bullish to neutral and you see what's going on. Is a first initial warning, I guess. But I wouldn't call this move set and done up until the point we can break down below these lows right here. That's cool for me. Let's go to Bitcoin. Um, a little bit of drawing in here, but I was talking uh, with Wally actually. Yeah, good lad Wally. Was pointing out this level because it was particularly relevant. It's the same level I was discussing in last week video, essentially the pour, the point of release, which initiated the pickup, and then it was flipped, and then it was flipped once again, and it still maintained that relevancy. Now, if you remember, I was saying Bitcoin going higher, it's not my base case for this week, and this was, 6, 7 days ago. And it's not that it went massively lower, but sure it didn't go higher. It stayed in this low down grinding move. Uh, so the point at which it bounced was, I think it was okay, right? I was expecting this bounce a little bit lower. I got these two levels right in here at 55 more or less and 50 mid 54. But I guess if you zoom in on the hourly time frame, um, yeah, I mean this level kind of makes sense, right? It is still this pour, this last pour before the peak up lower, which has been flipped in here, and then price went up and up and up and up. It drew back slowly up until it touched it again in here, and you had a massive reaction. So maybe, maybe I didn't zoom in enough when I was looking at when I was establishing that first downside target. Could be. Can we still hit that in the coming week? Mm, I mean, everything is possible, of course, but that my stand would change, would shift around now because we came close to it, and still we bounced into a good level overall, although I discarded it initially. So if I see it coming back down now below this low, I wouldn't like that. Let's just say I wouldn't be a buyer there, right? I wouldn't catch that knife. That would be my stand right here, right now. So let's have a look at yields. The yields had a little bit of a relief rally. Of course, they were majorly oversold. Or if you don't like the oversold, overbought type of terminology, you might say this was a pretty weak and extended leg. So you expect a little bit of a pullback, a drawback into it. But then they kind of gave these signs of continuation throughout this week. So at the current moment in time, I'm taking a step back into my, should I say, from my bearish bias on yields, and conversely from my bullish bias on bonds overall. It's not because I think the fundamentals have completely changed. It's just because something I was mentioning this week. I was having this conversation with the the usual German guy. We always talk about mirror trades, ranges, and whatnot. But we were having this conversation, which wasn't really related to markets and charts, but we were just discussing the opportunity of being a borrower, being a lender right now. And I thought, well, there is in markets what it's called the September effect. And if you look back, there is this tendency of yields going higher, and let's say starting into late August, September, throughout the beginning of October. And I was saying, I was looking at it, right? And I checked the last iterations. Of course, he's German, so in that particular example, I was just looking at the German curves. But if you look at US Treasuries, or even if you look at JGB's market, it's kind of one and the same. You got this tendency in yields to have a little bit of a rally in August, September, getting into October. So I say maybe we should expect a little bit of a weakness into the treasuries. I'm not saying they're going to crash back down, making new lows, right? But maybe a little bit of a drawback and not really keeping up the up move. It could be the only one counter to the September effect. It would be some sort of a bottleneck, some sort of a liquidity constraint, especially when you think about it in terms of liquidity availability in money markets. So, it could be repo, so purchasing agreements and whatnot, could be money market funds, could be a good number of things which have to something to do with money, financing mechanisms and whatnot. So that would be kind of the one thing which could throw the September effect aside, I guess. Because if you got a liquidity or let's say a dollar shortage, everyone is going to scramble for collateral. What is collateral in these money markets? It's US Treasuries. They they are still for some reason. I know people are not gonna understand that, and I know people are probably gonna scratch their head saying treasuries. Why someone in the market would think that treasuries are a pristine collateral? It would take probably another 30 minutes to explain that, so I'm just gonna leave it at that. You can Google it if you want, but that that's it. All right. The money markets and the monetary system, more often than not, in the 90% of the cases, I'd say, is moving around these treasuries, and they are used and pledged and repledged as collateral in order to get liquidity to then being used in other type of activities in the financial system. So hence why I say the only thing which, in my view, right now would impair the September effect would be a little bit of a constraint, a little bit of a shortage in that situation of collateral, liquidity, and whatnot. Some sort of an imbalance there, right? Um, there's also another thing I wanted to mention about bonds, which is not strictly about bonds alone. It's more tied in with the equity market. Uh, I had a screenshot about it. Let's see if I can bring that up. That was this one. Yeah. So in the standard 60/40 portfolio construction, you tend to have a little bit of a risk on assets like equities, stocks, and whatnot, and you tend to counterbalance it with bonds, with treasuries, and these type of fixed income assets because there is historically an inverse relationship in between them. So if your stock portfolio goes down, the bonds part of your portfolio is going to mitigate that because there is this inverse relationship, the flight to safety mechanism and whatnot. I screenshotted this chart, which was brought up by one of my, probably the only one I follow, one of my fellow Italian macro, call it what you want, analyst, podcaster, quote unquote influencer and whatnot. But the relationship was nice because he was highlighting the fact that if you look at these, I guess this is a dot plot type of chart. If you look at these, it looks like this inverse relationship is only true when core inflation is sustainably, it says, below 3%. And so just empirically, I wanted to look at these, right? Because we know that inflation throughout um, 2021, 22, 23, since the response to the pandemic, inflation went higher, right? With the breakdown of supply chains and whatnot. So I wanted to look at these and see if there is some validity to this idea that if inflation ticks up above 3%, the bonds and the stock market tend to have a positive correlation instead of a negative one. So let's look at that. Now, I don't know, let's start from here, right? 2020, Rona dump and whatnot, stock market plunges, bonds overall, and bear in mind these lines in here, these are basically the ETFs. So you got the long term, the TLT, the mid-term, and the SHAI, which is the short-term duration bonds, right? So major crashes in stocks, what you got, conversely, major pump in bonds. But then again, back then inflation was still below 2.5%, on the top of my head. So let's look at when these correlations started to break down. And it was around, most likely in here, because now, no, well, in here still not. The stock market is going higher, bonds are going lower, and at this point, probably broke down in here, 2021. Because now you see the stock market is going higher again, but in 2021, after the first quarter, bonds started to track the stock market going higher. Then the stock market, January 2022, started to go down, and bonds, January 2022, went down. Hmm, interesting. What was the low for 2022? October 2022, that was a decent low in the stock market. Well, decent, more than decent, but anyway. October 2022, yeah, I mean, it looks like it was the ultimate low for these assets as well. Probably if we can differentiate a little bit the, the the different curves, we can appreciate better. It might be that it was the ultimate low for what? For this one? Yeah, it traded a little bit below it, but overall, that was the low. For this one, yeah, it was the ultimate low. For this one, instead, it wasn't. There was another low. Uh, And this is, the long end. The long end actually went down even more. The 30, well, 20 to 30 years maturity. But all in all, these relationship, just again, it's empirical. I'm not taking out data, correlation coefficients, covariations, and whatnot. It's just looking at the charts the way they are, right? It's very, very basic. I have a very low IQ, so that's how I do things. Now, let's look at what happened recently, because now, if we check right in here, it should be this one, if you can load it up, we got core inflation, which is hovering around 3.2, so very close to that 3% threshold. It was highlighted in here, right? And it looks like that on the recent dump, this dump the stock market had, you see bonds are actually going higher instead. Yeah, the dump started at the end of July. Yeah, basically a week ago, the treasuries started to trade higher. Maybe anticipating it, maybe not. You got that quote unquote legend that the bond, the treasury market is where there's more money leave. So could be they seen something and the stock market just catched up with it a week later. Could be. So I guess this is not definitive, of course, because again, core inflation at 3.2, it's not below and sustainably below 3, but I guess it's going to be interesting to see if these keeps on happening while inflation and as measured by the CPI and potentially the core inflation data point will keep on grinding lower. So I was just thinking, you know what, I'm going to put it on my radar and see what's going on from here on out. Thought that was just interesting. Okay, so let's get back once again into indices, because this is where I wanted to really deliver that message. Okay. Um, so first of all, let's look at what indices did. We're going to look at the triple Qs and the spiders, of course. Now, if you remember, and I'm going to show you I actually took the screenshot so we can relate to that instead of asking you to make the huge effort of reminding what I was talking about last week. Okay. I'm just going to help you out with that right here. But the the two ATFs, they came back up with a massive pump. They completely smashed through what you would have expected to be a resistance at this point, like, from a structural standpoint, from a moving averages standpoint, and they basically reclaimed almost everything. Uh, SPY is now trading 2% below all-time highs. The Qs are trading 6% almost below all-time highs. So we had these bulls coming back, right? And again, I wanted to show this because I just wanted to present uh, these view, this approach. Whereas you don't have to time every single thing, you don't have to be right or wrong, but the process should be oriented in being a little bit more like if these and that. And I'm telling these because I had, as I said, many different messages, many different conversations where the theme was, so you were wrong. We didn't trade for new lows. Yeah, no, we didn't. Was was my base case wrong? Absolutely. Do I feel bad about it? No. I mean, it's not that I've made more money than I would have probably had, or that I lost a lot of money that I could have not lost. It's just, you know, sometimes you try to establish the path ahead for the markets. And as I said, you just look for evidences of things being confirmed or denied. So let's get into it, right? So starting off, let's close this down. Starting off with these, right? If you remember, I said this was my base case, all right? A little bit of a drawback and then probably a rejection, okay? But opening up the doors and leaving the doors open for the opposite scenario, and I on purpose, I I kept up the subtitles right here because this is what happens when a level you expect to be resistance is flipped, and this is the opportunity which is presented to you. You flip one, you confirm it as a flip, and you want to see price going up to the next level of previous resistance. So the level is being reclaimed. It didn't act as expected resistance. So now what you can do is shifting your expectations, your bias, your stance, and start to turn around even your intraday type of activity. Instead of waiting for rejection here and then hunting for shorts, now what you're going to do once the level is flipped and reclaimed, you're going to hunt for longs, right? So because this was the case, right? I was postulating the market is probably going to be pulled into these crosses of moving averages, and maybe you're going to see a rejection and a good low. It's going to be established around the 200 days moving average, which in the meantime is going to catch up, right? But these are my own words, right? I'm willing to take longs up until we reach into these levels. So I'm not saying, you know what, I'm going to sit on my hands throughout all of the week and I'm not going to trade unless if I can see the market getting there and then I just want to short. No. But if you have a decent expectation of these bounds, these rally being extended, why wouldn't you want to trade that, right? And the premise was these are crucial areas, okay? Are crucial in the sense that it doesn't mean that the market has to dump when it touches it. It just means that at that point, that's the moment where you want to see if your base case is either confirmed or denied. Okay, because if it is confirmed, as I said, even if you don't want to trade the actual area, you just want to wait for the reaction, the confirmation, and then you go intraday on your 5 minutes, 1 minute chart, and you're gonna hunt for short like there is no tomorrow up until the point you reach into what you think or what you deem as next potential level of support, right? And I also said at these levels, I'm probably not gonna push the pedal to the metal, but I actually want to take a step back and see how the market reacts to that level, right? So, you know, I think it's important to bring these messages home because again, I don't want to start. I don't want to go out of a tangent and starting a rant, okay? But really, I think it is an important message to deliver because when I read stuff like, "Ha, you caught that wrong," "Ha, you were wrong," "It didn't happen," "See, it didn't happen." Again, so what? So what? Look, and I know people which I usually entertain conversations with, they are well aware of this. Okay, so this is not for my usual trading mates, but to those people, maybe you're new to financial markets and trading and investing and whatnot. I just had the conversation yesterday, which was completely nonsense. But anyway, let's leave it out because it was already sad to read that stuff. But the message is that your job, whether you are an investor, whether you're a trader, your job is not to predict. You don't have to know what's going to happen next. I'm quoting Mark Douglas. You don't need to know what's going to happen next in order to be able to make money. Your first aim in the game is survival, right? So the major point you should have is risk management. Hence why I said I want to take a step back. I want to see what is going to happen because although I might think this is what is going to happen, I can't be 100% sure. Nobody can. And again, I'm gonna say it once again. If you know someone, if you talk to someone which is gonna present himself to you as, see that, I knew it. Oh, see, that's what gonna happen. That is what's gonna happen. Just stop entertaining conversation with these people, right? Look, deep inside, they do know as well. They don't know what the fuck is gonna happen next. All right. The name of the game, it's not being right or wrong. The name of the game is coming up with ideas which are going to allow you statistically to make money, whether you are right or wrong in that specific moment. You can be wrong on something, but still, since you've done your homework, you can know which are the triggers which prove you wrong, and then you know what you need to do next in order to keep on profiting or at least having the potential on a probabilistic type of analysis to keep on being profitable. If one door is closed, another one is open. The market needs to go somewhere. Okay, so if it's not going to go where you thought it would be, it might be, I don't know, just being a little bit sarcastic here, it might be that if you're wrong on something and the market is going the other direction, there are ways to be able to profit from the market going in that direction, although initially you thought it wasn't likely. So I guess it's true what they say. When I read these comments, I guess it's true what they say. Traders tend to marry and stay married with their biases and with their positions more than what they can stay or longer than what they can stay to their wives. People tend to be hooked on a bias when the reality is that a bias is always good up until the point you see it confirming itself. It's not good if it doesn't. It can only hurt you. So One of the main characteristic that, in my opinion, every good trader, every good investor should have, it's not the ability of actually forecasting the markets and predicting the future, but it's the ability of being able to be faithful to a bias, to stick up with an idea, to be faithful to your trading plan. But at that very moment, as soon as it is negated, it's invalidated, you need to flip. You need to have that mental ability to completely change your idea around and saying, you know what, I was wrong. It's pointless for me to keep on hammering this idea if the market is proving me wrong, right? So I started out the week by looking at what the economic calendar was bringing in, and my focus was actually looking at the market with the expectations the market was about, to trade a little bit higher and then reaching into these inflection points. And I was expecting a rejection, right? But what I wanted to do, it was analyzing the data points coming in and seeing how the market was reacting to them, because that is pretty valuable information if you know how to read it. Okay. And I said, this is not a trading plan by definition. This is more of a, getting the pulse of the market and see how the market digests things going on. Because this is a dynamic environment, as I said, and it can change around every single day, every single hour, with every bit of information of data point which is hitting the market. So you need to be nimble and you need to be cognizant of that. Okay. And look, here's the CPI data, and here's what I sent out. Okay. And look where we were in terms of the chart, right? We were just testing that moving averages I was talking about, and from where I was expecting a rejection. But the process is not about, you know what, guys, here we are going to dump from here. Let's load up on the short for the day because that's what's going to happen. No, look at what, and again, it's not about bragging. It's just to show you an oriented process type of a thinking. Look what I was looking at. The chart might suggest a potential buried outcome off of it, but don't forget the risks, okay? And the risks are, liquidity, passive indexing, earnings expectations, and corporate share buybacks. Why would you think I was bringing that up just 3 days after recording this video where I was postulating, yeah, we might have a rejection. It wouldn't be uncommon to see the market being pulled in these two moving averages while they're crossing to the downside. Why do you think? Why do you think once you establish a bias, you need to then coming up with reasons which are actually invalidating that bias? Because risk management is king at the end of it. So to all those people which, and again, I don't want to come across like arrogant, or sometimes it looks or it sounds like you're talking people down or you're calling them stupid. No, look, everyone has been through this and everyone makes mistake, myself included. That's just to prove that my initial bias was wrong. So we are all wrong at times, right? And again, it's not a matter of being right or wrong. It's a matter of acknowledging why and when and where you could be wrong so that you can lose the less amount of money possible. That's it. You know, if you want to post a video, I'm gonna go through the slides. These are basically screenshots of my morning brief that I share from time to time with my trading mates. But there were reasons for the market to actually not behave in the ways I was expecting it to behave. PPI was already out, and the market didn't tank. So that was the preliminary type of warning sign that maybe, you know what, we are pumping up. The yen carry trade situation is resolving itself. The market is responding positively to disinflationary type of data points like PPI. Let's see how CPI goes, right? And bear in mind these dynamics right in here. such as these, which to me is the most important, corporate share buybacks. So if you look at the amount of buying pressure corporations have generated, that's a huge buyer into the markets. And if you are a corporation and if you have the habit to be engaged in, you know, buybacks of your own shares, if you see them being discounted, like from across the spectrum, it could be from 5 to 15% right now that you just reported earnings. So for you, the buyback windows has just opened up. Why wouldn't you buy at a discount, right? And you can see the relationship in here in between buybacks percentage change and the S&P percentage change, and you can see how they are particularly correlated. So again, um, the message I want to try to deliver, it's not about being right or wrong. You're going to see many different people, myself included. I want to be the first in line saying I'm usually wrong. But conversely, I also, and this is where it's really hard to deliver it. I also know that doesn't matter how many times I'm wrong. I can be wrong 3, 4 times a day. I don't care. The point is that you need to lose the less you can lose when you're wrong, and to make the maximum amount of cash you can make when you're right. Now, of course, it's even better if you are right more often than what you're wrong. Absolutely, I'm not going to dispute that. I'm just saying that this old thing about calling it right, calling it wrong, it's just bullshit. It is just bullshit. So don't be caught up with that. It's not gonna serve you well in your journey, whatever it is. Okay. So yeah, I completely skipped throughout the oil futures curve while I was looking at oil, but it wasn't a screenshot. They didn't, well, they changed a little bit, but they have been revised lower pretty much. Yeah, the break evens are right. At this point, it's a little bit of an old story, but oil make this higher high, and at the same time, the break evens are making a higher low. So again, it's just another type of a divergence you can look at when you try to establish the reaction from these levels. But anyway, if you want to finish up with volatility as measured by the VIX, you see that on these massive reclaim pool, even if you look at it from a trend line standpoint, and I'm not, as I said, I'm not a trend line type of guy, but I I think I heard, I don't remember if it is correct, but when you got a trend line like this, so dynamic support, and you see it's bridged, it's a little bit of a probe. I should ask back to QBQ, but a probe, and then you see the probe which is broken, and now you expect higher prices. So it could work a little bit like that. At the same time, while you got the reclaim of the dynamic support in here, you see volatility contracting, and getting back actually below the levels at which it was when we got the push down, the breakdown. So, you know, well, I added the Nikkei just to highlight the fact that even the Nikkei kept on grinding higher this week. So it was again a very bullish week this week, um, and it might be that we're gonna see a little bit of a continuation. Hmm, maybe. Just closing out with SPY, or well, ES futures right here. I would say probably buying into it right here, right now. I don't know if I would do that because it's still previous resistance. So maybe waiting for something like before, like the resistance to be actually uh, broken and then retested for the flip, and then it just goes up. Also because We got what? 7 days which closed positively. Yeah, you might say, yeah, but we were just filling in, which we were just rebalancing the whole. Yeah, I could. I don't know if the market is going to give it to us, but maybe a little bit of a retest of these moving averages right in here, kind of could be a buying opportunity if the market is so gentle to give that out. I don't know, of course, but let's just say. But it could be around the 50, it could even be around the 20. But this area right here wouldn't be bad in my view to start to look for evidences. And again, pay attention to the words, to look for evidences that the market is going to reaccumulate around these areas and then grinding back higher. If it doesn't, well, too bad. I mean, it wouldn't be how much again? It was 2%. Yeah, 2% from the all-time highs. So could this be? We just moonshot and blast through all-time highs after this major peak up right here. This is some sort of a V-shaped type of recovery. Yeah, everything can happen. But again, I admittedly I might have gone through a ranking here. Um, but probably a little bit more than what I should have. Maybe I, you're gonna be the judge of it. But I just wanted to deliver this message because I think again, it's not going to be nothing new to people which have been in financial markets for more than 6 months or a year. But I keep on seeing these comments, these messages, I keep on having these conversations, and sometimes I guess instead of looking for someone which is gonna present you opportunities to say, yeah, you should buy in here, you should sell there, you should buy in here, you should sell that. I guess it would be much more valuable for someone which is just starting out right now to have a little bit of a much more process-oriented type of thinking and training. That would be my advice. It's the same old story. You give a man a fish, and he's gonna be good for one day. If you teach him how to fish, it's gonna be set up for life. It's kind of the same thing in trading and investing in financial markets. Don't listen to these people which are gonna just tell you, yeah, you should buy here, you should sell that. And just just try to come up with your own argumentations and then see if they are good or they are not. And if they're not good, the next step is going back through it and seeing not only where and when they were no good or they proven themselves wrong, but the crucial thing is the why. If you can find the why, or why you were wrong, or why do you have this issue, could be positioning, could be timing, could be whatever. Maybe you're just reading the market badly, but why? There's always a why. And I know people say that acknowledging you have a problem is the first step. No, yeah, of course, if you don't know you have a problem, it's hard to fix it. But after you found it, the next step that many people are skipping is the why I do have this problem. So I would suggest a little bit of a approach like that. And of course, it's going to be personal and everyone is different. But I can promise you that at least in my experience and for what I've seen in other people experiences and journeys, this is something which is gonna benefit you massively. And maybe it's not gonna seem like that next day, next week, but give it like 6 months, 1 year, and you're gonna thank me later for sure. I I'm almost 100% sure about it. So yeah, guess the message is delivered now. 1 hour mark. So let's cut it off at this point. Again, as usual, wishing you a good Sunday, a good Sunday afternoon and evening. And of course, as usual, for the rest of the weekend, which we have to go through, and for the beginning of the next week of trading, always be nice and be cool. Neil's out.